Well, good morning. I hope you're doing great. My name is Jason. I'm the CEO and Senior Advisor here at Sequoia Advisor Group. And today I want to take just a few minutes to dive into what's going on with these markets and, more importantly, why they're acting the way that they are. If you've been watching the market over the past few days, you've seen some pretty unsettling results, no doubt. Stock prices are not just slipping, they've seemingly fallen off a cliff. And so in times like this, it's easy to feel some uncertainty. But before we let our emotions take over, what I want to do is just zoom out for a second and try and put some things into perspective. So on your screen, you'll see a few two-year charts, one of the S&P 500, one of the Dow Jones, and one of the NASDAQ. And in each of these charts, what you see is significant growth over the last 2 years. So yes, at the moment, we're experiencing a correction of sorts, but it's important to understand that this is part of market cycles over time. The key is understanding the factors behind these movements, which can help us avoid making poor long-term decisions based on our short-term emotions. So I've got a theory about what's going on. In my last video, I mentioned tariffs as a catalyst for today's volatility, but I want to go a little bit deeper in this video. And I want to try and remove politics from the conversation and look systematically at how the tariffs, our national debt, and interest rates are all connected. So right now, the U.S. has about $36 trillion in debt, and about $7 trillion of that needs to be refinanced this year in 2025. I've researched this pretty extensively over the last couple of days, and it's difficult, if not impossible, to find the exact interest rates of this portion of the debt, but we can make some educated estimates. So most of the debt that we need to refinance was issued when rates were around 2 to 2.5%, meaning that if we were to refinance at today's rates are closer to 4.5%. And so the cost of those interest payments would more than double. And this is a big deal. Government simply cannot afford to refinance all of this debt at rates that are double or even higher than what we're paying right now. It would certainly create additional strain on an already strained federal budget. Lower interest payments have to come from somewhere, though, and there are only 3 options from which to take them. We could print more money, which would increase inflation even more and would add more to the national debt. We could raise taxes, which would take money out of Americans' pockets at a time when they need that least, or we can reduce government spending. And one of the ways to reduce government spending is to reduce the interest that we're paying on debt payments whenever we have a chance. So this administration seems to be wanting to bring down interest rates before refinancing all of this debt. So then how do tariffs play a role in that? Well, among other things, this administration is using these tariffs as a tool for bringing down those interest rates. Tariffs are like a tax on stuff that we buy from other countries, but it certainly creates a lot of uncertainty in the markets. And as we've talked about, investors hate uncertainty. And so they pull their money out of stocks, which then, of course, causes stock prices to go down. But an important question to ask is, well, where does all of that money go? Well, a lot of that money flows into the bond market, and increased demand for bonds pushes those prices up. And this is a little complicated, but it's important to understand it, to understand this theory. A bond is just a debt instrument. What I mean is a bond is basically a loan that has an interest rate assigned to it. And this means that when you own a bond, it's paying a set amount of interest, which is determined by the prevailing rate at the time that that bond was issued. And there's safety in that, which is why bonds are often considered more safe than stocks. Now let's imagine that you purchase a bond for $1,000 and that bond is paying 4% per year, or $40. And during the time that you've owned this bond, for whatever reason, uncertainty has entered into the economy, and so many more people are looking for that safety that you've got. Well, this makes your bond more attractive to other buyers. And so like we said a moment ago, anytime that demand increases for something, the price also increases. And so because of this uncertainty, let's pretend that somebody wants your bond so badly that they're willing to pay $1,300 so that they can get that same $40 payment. You paid $1,000 for that $40 a year, which is a rate of 4%, But this person who paid $1,300 for that same $40 payment is only achieving a yield of 3%. So the difference between what they pay for the bond and what the bond is paying is called yield. So what does this mean? It means that when bond prices go up, yields go down. We're seeing this play out in real time. Because more money is flowing into the bond market, the 10-year Treasury bond, or yield, which was paying 4.8% earlier this year, has already dropped to 4.2%. And lower yields mean lower refinancing costs for the government. There's another component to this. When stock markets are under pressure like they are now, the Federal Reserve feels more pressure to lower rates to help stabilize the economy. A few examples. 1987 was Black Monday, S&P was down 20%. 2008 financial crisis, the S&P down 57 peak to trough. And in 2020 COVID crash, the S&P was down 34%. And in all of these cases, the Fed stepped in and lowered rates in order to calm the markets. So why does this matter to you, though? Because this isn't just about government debt. It affects all of us. Lower bond yields mean lower interest rates across the board. Mortgage rates, for example, are closely tied to that same 10-year Treasury yield we just mentioned. And as yields have come down, guess what? Mortgage rates have dropped, and mortgage demand has jumped more than 20% in just a few weeks. Lower interest rates make money more accessible to everyone. It allows people to refinance their homes, which there's great need for, allows them to invest in businesses and fuel economic growth of all kinds. So what happens next? Well, at the beginning of the year, the Federal Reserve was not signaling any rate cuts for the year. But today, markets are pricing in 75% odds that we'll see at least 2 rate cuts before the year is over. If the market slide continues, and it's certainly going to be volatile, the pressure on the Fed is only going to increase as well. So where does that leave us as investors? Well, if history is any guide, and it is, short-term volatility often leads to long-term opportunities. So by understanding the mechanics behind these moves, we can make better decisions and avoid reacting emotionally to short-term market swings. And this is why we believe that long-term planning is so important. If you've got questions about how this affects your portfolio or if there are strategies that make sense for you in this environment, please reach out. We are here to help, and we want to help you navigate these moments with confidence and with clarity. And so as always, I appreciate you watching, and I hope that this was helpful. And as always, stay informed and stay patient. Until next time.